We had a little question come up in the trading room about, or in the options room, I should say, about trading covered calls, and I was trying to think them through by kind of answering the question in pieces as best I could, and maybe you guys can, short of me reading an entire article on this right now, you can help me talk through this here as a strategy. So here is a profit and loss or risk profile, I guess we really should call it, on Riverbed, and I've adjusted the stock prices. Riverbed currently closed at $19.99, but for purposes of our discussion, I've adjusted it to $20, and then a plus 10% and minus 10% move is giving us $22 and $18. That's these red dashed lines here generating some slices on the screen. I don't know that that will really mean a whole lot to us for what we're going to talk about. And then down here I've added a bunch of various call opportunities between the January, February, and also March calls. And we're starting off with looking at $100 that you may perhaps own in Riverbed at $20 a share versus selling one January 19 call, which is currently trading, I believe, at $2 and, or was it even that high? Or did I inflate that? January 19 call is at $1. Why did I make that 2? Let's make that $1. Or maybe I was trying to go back in time. So what we talked about was the fact that once we run out of theta on our option, and actually at this point, let's change our Greeks here. So we're losing about 2 cents a day on this, and we are a day away from expiration. 2 cents a day is not actually making sense to me. It should seem to be a lot more than that at this point, since it's going to expire next week, right? Or this week. No, it is tomorrow. What am I thinking about? I think I misspoke about that earlier when I mentioned oh, you know what it was? I was talking to somebody earlier about Martin Luther King, the Martin Luther King holiday. A couple of years ago, that holiday fell on expirations week. And I was mentioning that I had a pretty nice position. I had about, I don't know, I think it was about 10 calls in Apple from the week before. And I was up about $1,000 going into the weekend. Earnings were due out the following week and were actually looking good. And I was actually looking to make a killing on the trade. And hello, Simon. And as it turns out, that Monday, with the markets closed, Apple announced that CEO Steve Jobs was going to take a leave of absence from the company and address an illness that he had. And of course, with no ability to get rid of those options on a Monday, the market just completely evaporated on Tuesday. And even though, and I was really new to trading options, so I didn't fully grasp what was about to happen. So even though I had a few $100s of value to them on Tuesday, I still held out some kind of crazy belief that when the earnings came out, and they were supposed to be good earnings, that the shares would rally and I'd get my $1,000 profit that I was looking for. Forget about the fact that those $3 contracts were now worth about 30 cents. So anyway, the bottom line is at the end of the week, I lost all that money. So good times. And that's why I was thinking it was expiration week next week and not this week. So go back to the risk profile. I'm not sure these January calls are even a valid explanation at this point. Why don't we say that we have the 100 shares at 20, and we have the January 19 call that we sell at $1. So according to the chart here, and if we go by the green line, in fact I can adjust the date here and make the white line kind of match the green line anyway. So on expiration on Friday, this trade's value is $19 if the stock price stays where it is, stays at 20, then the value of the trade is 19. So I think that makes sense, right? Why is this? Let me try to get this adjusted. Okay. So if we did that, that means we're going to put $2,000 in on the one side. We're going to bring in $100. But then are we losing all the money? Is that, maybe somebody can help me talk this through here. Oh, that's why that happens. Thank you, Dyla. You're gaining theta if you short the call. Okay, I'm not thinking of it backwards. So here's the deal. I don't know why is this saying 0? Do I have something checked I shouldn't have checked? This is 20, this is 10. The profits would be 0. Maybe because it's saying I spent the $2,000 already. Drew all this out, and now the chart's not making a lot of sense to me. Let me see if I use a different option. In this case, capping out at 100. Now I'm starting to think if I should even bother drawing this out. Let me get my pencil and my paper. So if we spend $20 on 100 shares, that's $2,000, right? It's showing I don't have an open position, but I have the $100 stock right here. Is that not? Yeah. That should be factoring in the $100, 100 shares rather. So if I get rid of the 100 shares, there's simply the value of the option. Let me see if I adjust this, and nope. But I guess what we're doing is we're capping our losses here on the downside. Is that the idea? That shows your profit and loss on open positions. It does, but this is on simulated, so that's why we're looking at simulated trades. It will, if I had a trade, and somebody said this earlier, if I owned Riverbed right now, then it would show up here on this top section. That's why here hide simulations, hide positions. See, there's no positions being shown right now. So I've added a line item here for 100 shares of Riverbed at $20 a share, and then I've added a bunch of strike prices, but I can check them on and off here, and so I have that option sitting here, the January option, selling it for $1. And now the screen seems like it really got a little wacky here. Oh, because I got the stock. So if I just have the stock checked off, obviously at $20, that's my break even. I spent $20 on the stock, and if the stock goes up higher than $20, then there's my profit line on to infinity off to the right. And if it goes below $20, then there's my losses down below 0, down to the number 2,000 should be here on the left-hand side, because that would be the most I can lose. If we sell a $1 call against this, this is where this thing's getting a little skewed. As long as the value of Riverbeds stays above $19 a share, then it would seem to me that we'd get to keep the stock. And we would also keep the $1 credit. Does that sound right? January 19 call with a $1 credit, which of course is $100. And then the point being that in reality, instead of being $2,000, we would have $1,900 as our cost basis at that point. So to make this represent $1,900, we can actually change that to a 9. Get rid of this. So now our cost basis is down here. And since the shares are trading at 20, we're going to be up $100 at the end of the week. Let's say next Monday. Then the question is, if we roll out and then sell the February call, so January expires, and then we get the February call for $2, or sell it for $2, then let's check that one off. And we'll move this to expiration date February 16th or 15th. I guess we really got to go the one extra day so we get to the end of the day. So again, as long as Riverbed finishes above 19, we're going to keep the full credit of $2. It's when it drops below 19 is when we start losing money. Now, in this case, you see we're still above the zero line. And I think this was kind of the question. Where's that break even? And if I slide this over, we see our break even is down here at 17. So even if the value of the stock drops below 19, we're still going to be in the money when we combine it with the credit. And if, let's say, it went to 18 on expiration, and then this gets called away from us, we would have kept the $100 from the first month and the $200 from the second month and be gone the stock. So it's almost like making $3. Is that about right? If the stock is below the strike, we keep the stock? Okay, so I guess I'm saying that backwards. If the stock, so you're saying if I sell a $2 call and the stock goes down to $15, that $2 call is going to expire worthless. And I'd keep the stock. So I'm going to accept that. And I'm also going to say that I'm having trouble wrapping my head around this. I probably need just some more graphs and charts in order to wrap my head around it, and I don't mean to take up your time. In doing that, I appreciate it very much. I do have somebody contacting me on Skype here. And, okay, here I thought he was giving me my name, but he's giving me his name. And let's see, is he signed into the chat room? Doodle-doodle-doo. Doodle-doo. Nope, he is not. Okay. Well, thanks for checking in there, Simon. Dyla, you are welcome to call in if you think you can straighten me out on this. I would at least like to have the screen show what it is you're describing, and then even if I don't get it, maybe someone else out there will get it. Absolutely. I'd be honored. Now she's got to go find her microphone. and her headset. Figure out where her mouse is. Wow, it actually rang fewer times than yesterday, so my computer must be feeling a little bit better today. Welcome to Briguy's After Hours Die Laughing. How are you?
I'm good. How are you doing?
I'm doing okay. You probably saw earlier the question that came up in the options room, and I tried to do my best to talk it through. And in the end, Furthers, I think, walked away saying that he got it, but I'm not sure I'm getting it. So I don't know how he got it, but I must have said something right.
Well, we were talking about different things, and I think his question was, well, let me look at the chat room. As I recall, his question was, hey, I have this covered call. I bought the stock. There is some time left to expiration. The strike now below where the current stock price is. Therefore, if it were going to expire right now, the stock would get called away. But given that there is more time to expiration, is there anything that I can do besides just wait for this thing to play out? In other words, wait for them to call the stock away and make more money. Am I making sense?
I believe that's about right, yeah.
Okay. So, the answer, with all of trading, the answer is always, it depends. It depends on what the stock is doing. It depends on your risk tolerance. All these different things come into play. So I was getting a little bit confused on what exactly it is you were trying to demonstrate, or, is that the question you were trying to answer, or were you just trying to wrap your head around the covered call in general, or what's the goal?
Okay, well, I didn't have all of his information about how much he paid for the stock and how much the call was going for when he did buy it or sell it, I should say. So I just try to make up some numbers, and I don't know if these numbers are going to work out. Let me ask you a dummy question, and that is, if you're going to let the stock get called away, so in this example I have on the screen, you buy Riverbed for $19, and you sell a February $2 call.
Wait, a February $2 call?
A February 19 call at $2.
Okay.
That's what I have on the screen. It's the second red line item here. So my question is, if the stock does drop below 19, you're saying to let it get called away, right?
No, if the stock drops below 19, it won't get called away.
It won't get called away.
And you get to keep the $2 premium that you got for the call.
And the stock.
And you get to keep the stock. That's right. Now, if the stock goes over 19...
Over 19.
Then it gets called away.
Then it gets called away.
Right, because whoever bought that call and paid you $2 wants to buy your stock for 19 and sell it into the market for 22 or whatever it is it's selling for at the time.
So what happens to the $1,900 I put up to buy the stock?
You get to keep the $2 per contract share that you got for the call, plus you get the money that the person's going to pay you for the stock. So you're going to get $19 per share for the stock, plus the $2 that you got up front for the call. So your total return is going to be $21.
All right, so maybe that's the part I'm missing. So when we talk about your stock getting called away, you're not giving it up. It's not like you just handed it over to somebody and it's gone.
No, they're buying it for $19. That was the contract. They paid you $2.
There we go. Maybe that's the key.
Yeah, they paid you $2 to be able to buy your stock for $19.
There you go. Okay.
So if it goes to 24, do they want to buy your stock for $19? Heck yeah, because they can go and turn around and sell it for 24.
Okay.
They call you up and go, hey, Briguy, I want to exercise my call. I'm buying your stock from you. I'm giving you $19. That was our deal.
Okay. So that's, I think, where I was having the disconnect. So we have at least, basically when you're doing this, is if you're wrong, you're just capping your gains.
Exactly.
Ding, ding, ding. Well, you make
Yeah.
it sound so easy.
So if the stock starts going to the moon, if the stock does go to 24, I think what the question was in the chat room today was, hey, I bought the stock for 19. I sold the $19 stock for $2. Therefore, my cost basis is now 19 minus 2 or 17, correct?
Okay.
That's what he's saying. Okay. And so his question is, now the stock's gone to 24, but the most that I can make is the $2.
Yes.
So is there anything that I can do? And the answer is not really. I mean, there is, but the thing is, when you do a covered call, what happens is when the trade goes right, that's just the way it works. You've capped your gain, and really you should be, letting it get called away and doing your happy dance, because that's what you want to happen.
Okay.
You want them to call the stock away. If you think the stock's going to continue to go to the moon, you can open a new trade, a completely different trade. You could sell another covered call.
Okay, now that gets into a little bit of what I thought the question was, which is at what point do you buy back the call in the 1 month and then sell a call in either a higher strike or into the next month?
I think most people just let it get called away and then do it all over on Monday, the following Monday.
That's fair enough.
Yeah, I don't know that it makes a lot of sense to do any rolling, because once you start rolling, well, you're going to have commissions anyway.
Right.
When you open a new trade, you're going to have commissions. I'm trying to think if there's any reason to roll it.
Well, because I remember...
You could roll it.
Okay. I remember what Further was mentioning was some kind of a break-even point. Maybe that's not the right term, but there was like some kind of a sweet spot, let's call it, where it made sense to close the one call and then buy the next one. And I see Tomahawk talking about buying it back, buying the call back.
Yeah, I don't know if there's a sweet spot as far as that goes, because you're getting the theta. You're getting the theta either way. You're either going to get the theta on the current month, the front month call that you sold, or you're going to start getting theta on the one that you roll it to if you roll it out to the next month.
Mm-hmm.
But yeah, the break even is whatever you paid for the stock minus whatever you got for the call. That's why you just had it down there around 17.
Yeah, when I had that one checked off, right?
Right, that's why the
back.
break even is at 17.
Yeah, I can see that now. So if it trades above 19, that's why you're keeping the $2. And that's why this is showing the profit at $200. This must be just focusing on the options. That's why it wasn't making sense. I was losing the 1900 in this graph. But apparently this graph is not mentioning the stock itself. It's only looking at the options.
Okay.
And so it's demonstrating that if it stays above 19, you keep the full $200 profit.
Right.
If it drops down to 17, then the stock gets called away.
No.
For 17.
No.
No, correct me.
No, the stock doesn't get called away for 17. 17 is your break-even point.
So how is it break-even? What's the break-even aspect of it?
What you did was you bought the stock for $19 per share, and you sold the call for $2 per share.
Okay.
That's your break-even. 19 minus 2, that's the 17.
Okay.
So what happens is, if the stock falls below 17, then you start losing money.
Okay.
If the stock closes, let's put it at 18.
Oh wait, I think I know what you're saying, because the stock will be worth 17, so I'm out my $2
Right.
that way. All right. Okay. I'm getting there.
Right,
It's the mix of the stocks and the options. I trade a lot of options, so getting into combining it with the stocks is the part I'm trying to wrap my head around.
Yeah, it can get confusing. It takes a long time to get used to trading options. At least for me, it has.
Yep. Okay, but I think you helped me with that, just mentioning that. So let me just change this to the February 21 call, which was $1. So it's a $2 difference, but you're only able to get $1 for that. And now we're saying, now the P&L says it's $300, and that's because the stock, if somebody called that away at 21 and above, they'd have to pay you $2,100 for it, no?
That is correct.
Not, they wouldn't be paying 19. Oh, because it's a February 21 call. Duh. All right.
Right.
So they have to buy it from you for 21.
They can if they want. They don't have to do anything because they bought the option.
Oh, right. But if they do, so they buy it for 21, I only paid 19, so I'm getting $2 there. I keep the credit, so that's another $1 there. So that's $3 I would get.
Exactly.
And that's why this says that anything above 21, I'm going to make $300 on.
Right. So even if it goes to 24, you still only get 300. But that's good because that's what you wanted.
Okay. Oh, interesting. Intriguing. So now if we roll this out to March and look at the March 19, and that, let me round that off at 2 1/4, and we'll call the other one 1 1/4. So again, this is a green. Let me look at the green number. So 225 is what we would make over 19. Now I see why you guys do this every month.
Fun, huh?
Yeah, interesting. Interesting. I'm trying to read some of the comments to see if these guys are just cheering or are they're adding some info here.
I see some whoop whoops from Tomahawk. He's always good for the whoop whoops.
All right. You know what? I think I just a little light went on in my head on this conversation. It helped a lot.
Cool.
So, how are you doing otherwise?
I'm doing fine, thanks.
Very
How are
good.
you doing otherwise?
Still trying to learn. Still trying to learn it all.
Yeah, me too.
But I got some GLD calls that are working out okay, and I double checked the charts this morning, and I still felt good about gold on that pullback. In fact, I was going to show that on the screen, and sure enough, the thing came back in full force, and I made out on the pop.
Excellent.
Oh, and I also took some advice from you, and I talked to my broker and said, you know what, broker, there's these other markets out there, these other brokers out there that are selling option or charging their option fees in minuscule amounts compared to what you want to charge me, Mr. TDA. And how about you do a little bit better?
You're with Ameritrade.
Yeah. So I'm not saying this is going to work for everybody out there, and I'm not saying I even got the best deal because I think I could do better. But for now, I got the per trade part of the commission to be taken away.
Excellent.
So I'm down to paying just a per contract fee. They're charging me $1.50, so that's a little bit more, I think, than what you guys are paying, right?
Not by much, though. That's a great price.
That's not bad. I know there's other traders here that are doing 75 cents with Ameritrade, but I just think their volume might be a little bit more than mine.
No, that's great. I mean, when I still have a TDA account, and when I trade with them, I still get dinged for the $10 per trade, and then another $1.75 or something for the options. So yeah, it's really painful.
Yeah. So that's just a little, suggestion, all you guys out there, and you gave me the idea because you were also using IB, and I thought you were using those for options, but I could be wrong.
No, I do. I use Interactive Brokers. I switched to them. Oh gosh, it's been almost a year now.
Okay.
And best thing I ever did. I tell you, I haven't done the math, but I've probably saved thousands of dollars easily.
Yeah.
Just on commissions, and it makes it so much easier to do the trade that you should do, because when you start looking at commissions and it starts to affect whether you want to enter or exit a trade,
right,
that's a bad thing. You shouldn't be making trade decisions based on how much it's going to cost.
Absolutely.
You eliminate that from from the equation, it just makes it so much easier.
Absolutely, and that's what made me approach it. And I try to get them to do it for $1, but they wouldn't do it based on my volume, and my volume hasn't really been there this past year, and maybe the last quarter I've started to trade more and more, and I figured maybe I'll just give it another quarter or two, and then maybe go back to them and see if I can get them to drop it to $1. But for now, it does make it nice that you can get into a trade and not think that I needed to go at least 30 cents before I'm going to make anything.
Right.
You know what I mean?
Yep, I know exactly what you mean.
So that's that makes it a little easier, and especially, and another thing I learned from another member here at daytradingradio.com is to not think that you got to have 10 or 20 contracts in order to be profitable. So, just doing a couple of contracts and keeping it simple. I
do one contract. Unless I'm I'm trying to, make a home run on a contract that's 35 cents, and I'm thinking it's going to move a lot, and I want to buy 3 of them. I buy one contract. That's it.
Look at that. See that when I first was doing options, the guy had it stuck in my head to get 10.
I was doing that too. Boy, that was an extensive lesson.
Oh man, having $50 in commissions in every trade that you're trying to break even on.
Yeah, that's painful. It's fun when they go right, but when they go wrong, it's really, really painful.
True. Okay. Well, thank you so much for calling in, Dyla.
You're welcome. Good to talk to you, and I'll talk to you again, I'm sure.
Yes, very good. Enjoy the day.
You too. Bye-bye.
All right, so that is that. So, guys, if you want to call into the show, I try to tell you, I don't want you to feel pressured into being on for half an hour or an hour. You're welcome to just come on like Dyla there, straighten me out a little bit. I was just getting a little stuck on that observation, and it looks like we got past that, so I really appreciate that. So, got a text messages coming in, and I have a feeling I heard my wife's car start, and she's sneaking out without telling me anything. But that's okay, she's allowed to. And I'm getting a question here. Question from our viewers. Let me check in with my producer. Sammy, is that a viewer?
Yes, it is. It's a viewer.
And they are asking, could you close out a covered call if you're taking heat on it? So let's reason this out here. This went back to GLD. Let's put Riverbed back on the screen. So, could you close out a covered call if you're taking heat on it? I'm trying to process what it is you're asking. So that would mean that the value of the call is going up, right? So you sold it for 2 and now it's worth 3. Let's take the February example here of 19. So you sold it for 2 and it's worth 3. I think the lesson here, and again, I'm not going to tell you guys I am a professional on covered calls, because I really, I've not really played around with them. I don't have experience trading them, and at the same time, I've heard plenty of seminars and hours and hours and hours of video, and seen this as presented as a wealth building strategy. Let me just put it that way. So absolutely worth checking. Oh, and we have a caller checking back in with us, perhaps looking to answer that question. Dyla, on the line.
Hi.
My goodness, that didn't take long.
No, it didn't. No, it didn't. Oh, you know how if you're taking heat on a covered call, that means the stock is dropping.
Oh, okay.
And if the stock is dropping, the call is dropping too.
Oh, so it's not going the other way. All right, so I said that wrong.
No, the call is probably going to go to 0 if the stock is closing, or if the stock is dropping on you.
Okay.
So in this case, if you bought it at 19 and we were talking about this case before where your break even is 17.
Right.
And I see that's the one you still have on the screen. Well, if your stock goes below 17, that's where you start losing money.
Okay.
If this stock goes to 16, you're down $100.
Okay.
So what you can do in this case, and absolutely you want to minimize your risk, because your maximum risk is the whole thing. You know, this, if the stock goes to zero, you've lost it all. So yes, there are circumstances under which you want to limit your risk by closing the trade. Now, what will happen if the stock starts dropping is the call will become, you know, worth less and less until eventually it's worth nothing. So what you need to do is close that call contract out by buying it back.
Okay.
So you sold the call for $2. You need to buy it back for 50 cents or whatever it is.
Mm-hmm.
And once you've closed that call contract, then you can sell your stock.
Right. Right. Yeah. That aspect, that's the literal aspect of how to do it, because you can't have a naked call by selling the shares first.
Exactly.
Unless you've got plenty of money in your account, and your broker will let you do that. But the point is to get rid of the call first. And it seems like if you're taking heat on the trade, which is what the question was, if you're taking heat on the trade, then the idea would be to evaluate your trade and get out of it. And not worry about the fact that the option's taking heat, because really the whole position's taking heat.
Right.
Is that the idea?
Yeah, that's what I was assuming that the question was, you know, what if the trade is taking heat? Yeah.
And let me ask you this, because it would seem to me, based upon looking at this risk graph, that I have a $2 cushion between 17 and 19 to make that decision.
That's right.
Okay, so that's another interesting aspect here, is that if there is some bad news coming out or the chart's breaking down, I mean, granted, something awful can happen and it could drop $5. I guess that can happen. But, you know, whether you own the or sold the call or you didn't sell the call, you're still going to be in trouble. But in this case, if it's just drifting away, you thought it was going higher, but it's drifting away, you've got a $2 window to finally decide to get out of the trade altogether.
Right.
Okay.
Yeah, you know, this is a great tool. Here's another way you could use it. If you bought the stock at 19 and all of a sudden it goes up to 22, but it looks to you like it's going to roll over and you don't have any short calls on the position, you could sell the $22 call in anticipation of the stock rolling over, keep the money from the call, and then if the stock does go back down to 19, you still get to keep the money that you got for the call. Does that make sense? No.
I was typing something while you said that. I'm sure for the viewers it made a lot of sense. I'm so sorry.
You know, there are a lot of things that you can do with covered calls, but that was just one more example of the way that you can use the call as a tool to trade around an existing stock position.
Listen to her with the tools of the trade reference. Such a nice team player. Appreciate it.
Doing my best.
All right, Dyla. Thank you so much.
You're welcome. I'll talk to you later.
All right. Bye-bye.
Bye.
And we did have another viewer that wanted to call in, said he just had a few moments, so I'll leave the lines open for you to do that and give another comment about covered call strategy. And we do our best here, right? DayTradingRadar.com. Try to help out one another and give some on-air advice. In fact, in a sense, this after-hours show, for at least part of it, I like it to be something where you guys can ask questions like this, and I'll do my best to research the answer for you. And if I can't answer it, maybe we have another member who will be able to answer it for you, and try to keep it fluid that way. So I don't know if that caller is calling in. I won't put them on the spot, but if they don't, they don't. That's pretty good. Oh, there they are. Pop it on the screen. There we go. Well, hello, Dr. Gass. Good to hear from you.
Hey, thanks for having me.
Sure.
Let me turn something down here.
No problem. So I got a private message from Gass saying he had a thought or two on, I guess you were saying, a position that you had open.
Yeah, I was hoping to have Dial-It back on. Maybe we can get her to come back in.
Okay.
Can you conference?
I can if she calls in, sure.
Okay, well, hey, let me just tell you real quick, because I got to run, but I got in, I was trying to play the Wells Fargo bounce.
Okay.
And I ended up I bought a little higher, and then I ended up adding a couple hundred. So I ended up with 300 shares with an average of where am I here? I got 35, basically 13, right? So I was able to sell some covered calls for the 35 for a pretty nice premium. I ended up selling with two levels, but basically I got about $32.50 per contract.
Oh, okay. Yep, she's on now. Hi, Dyla.
Hello.
Hey, so hi, Della. What I wanted to make the point is that instead of selling 3 contracts and tying up any strategy I might have to sell any of the common, I sold 2, which meant and they're January, so they expire Friday.
Okay.
So I was able to collect, basically. What is that? 32 times $65 or so in premium, and that froze 200 of my 300 shares. But with the other 100 shares, the last 100, I can actually, if the stock was to pop, I at least could capture that profit, and I know I've now made some money on those 2 covered ones because it's more than what. That, in other words, if I give them away at 35, I only lose 13 cents per 100, right? But I've now taken in over 32 cents
By selling the 100.
By leaving 100 shares free to sell, and if it popped on me, I still have the ability to capture some better profits. And I know that now with the 200 sold calls, I've at least locked in some small profit. And all I have to do is wait till Friday for that to transpire.
Okay. So you're talking about this as being an earnings play?
What happened was that the stock got hit pretty hard, so I was just trying to get a bounce out of it. But I failed to get it to work.
This was this recent report?
Yeah.
Okay. And it got hit hard, or your position got hit hard?
No, I wasn't in it until the news came out.
Okay.
It's only after the news came out that I go after it.
I see.
And then, ultimately I was just a few cents away from being break even. But the beauty of it is that I went to basically in the money calls, and I got a pretty good premium for it.
So why did you want Dyla on?
I wanted to comment on the fact that I left 100 shares free to react to the market.
Yeah, that's a great way to do it.
I mean, I didn't really think of it until Lear and I were talking about it just in a private chat. But actually, now that I've experienced this, if you will, it's the first time doing this for me. But once you sell enough covered call against your position, there's nothing you can do about it, right? You're locked in until expiry, right?
Right.
I mean, in essence, there's obviously situations that you might take a loss or a gain, whatever. But the point is that sometimes selling covered calls against part of your position still leaves you some ability. That was going to be my take-home point.
Yeah, that's great. If you have enough shares to let some run and sell the covered calls, yeah, that way if it does run off on you, you don't feel like you've shot yourself in the foot by limiting your gains.
Yeah, so I guess my point was selling, not 100% of what you can sell, but a portion of it actually turned out to be not a bad way to approach it.
Okay, and actually I can graphically show that on the screen, because if we just had the stock and our break even at $35.13, you could see the angle that this takes, so that, for example, a 10% move at $38.50 is going to get us $1,000, $1,009, whereas doing the covered call on 200, you notice the graph still gives you this infinity view, and out to $38.50, that 10% move, your profits are capped. You'd only be able to gain $440. So, you're losing about $560, it looks like. But that's better than having the 200, because at $38.50, it's only $104. That's all you would gain.
Yeah, so So I guess my way of looking at it is I was able to lock in, not a big profit, but at least
But
lock in a
something.
profit. And I had to wait a week for that to play out.
Mm-hmm.
And if the stock runs, I still can sell some for a profit. And
Mm-hmm.
if it tanks, I'm only left with 100 shares at whatever loss I'm looking at.
Right. Right.
So it was a way to lower my exposure and take a sort of a baby step in profit.
Well,
Anyways, I liked it. It
as
was something I think it was a good way to approach it. That's all.
cool. It's another perspective, and I tell people all the time. There's no straight answer on how do you trade with options because it makes it so creative about what you can do.
Yeah, I mean, I have some larger IRA positions that if I was as sophisticated as I am now, I would have sold some covered calls, not taking the boatload just because you still have the ability to profit, from a move.
Mm-hmm.
Anyways, that was my little 2 cents, and Dial, I don't know if you have any comments about going 100% with covered calls or whether you're better off trading a little smaller. That's all.
It depends on, like Kumar said, it depends on how you feel about the stock. If you think if you have 200 shares and you're not really sure what it's going to do, but you think there's a possibility that a news event is going to cause it to go up 20%, then yeah, it makes sense to leave some of those, loosey-goosey out there and take the small gain, the more certain or the higher probability gain on the call. Yeah.
Yeah, I mean, basically what I did was, just to recap real quick, is that, my first entry level was too high. So, ultimately the sell-off was worse than I thought. So I ended up adding 200 more. So now I brought my cost basis well down, but I still wasn't able to get out.
Excuse me, boss.
Whoa.
You have a text message.
Anyways, this way I lock in at least, I've saved at least 2/3 of my position from taking any kind of a beating. And I kind of like this. I kind of like how it's working out, and it's new, first for me, and basically I wanted to throw it out there to give people the concept that you don't necessarily have to tie up your entire position with covered calls.
Yeah, there's nothing in trading that's an all or nothing. That reminds me again of commissions. If you have high commissions, then you tend to think about things, I think, in a little more of an all or nothing way because, if your commissions are $1 to buy or sell 100 shares of stock versus $10 to buy or sell, are you more likely to scale in and out of things
Not
or
at
not?
all.
Sometimes it does make sense to do things partial. I see Docklands all the time, taking partials in the futures room. And it really makes sense to do it that way.
Yeah, great point. Well, anyways, I'm going to run. I appreciate the chance to at least throw that out there, just to give food for thought, if you will.
Yeah, thanks for that. Appreciate it.
All right, buddy.
Take care.
And Dial, thank you so much.
No problem. Nice to talk to you.
All right. Bye, guys.
Love to hear you guys on.
Okay. Take care, Darla. Stop calling me, will you, please? Somebody's going to start asking questions. No,
Okay.
just kidding.
I'll make
Just
you
kidding.
call me next time.
All right.
Okay.
Adios.
All right. I probably shouldn't say that. Poor Dyla. I didn't mean it like that. I appreciate you calling in. So we're getting a couple of viewers here texting in. They see my number there on the screen. And I guess people just love sending random texts out there. But for the person that sent in the question about covered calls, I hope you got the answer you were looking for, or at least an answer that helps you getting closer to what you're looking for. Because I'm here for you. That's what it's all about here in the Briguy After Hours show. So I think we covered quite a bit. There's probably a lot more we can get into, but we're not going to drag this into an all-night show because otherwise I'd get nothing else done, right? So I'm just going to take the main ES chart. Let me figure out what screen I put that on, and we'll leave that on the screen for you. Let's see, where did you go here? There's the earnings reports. Pardon me. Oh, incoming call. Hang on a second. Let's see if we got a viewer calling in now. Okay. If you do decide to call the number, just know that I don't have a way of tying you into the line. But you're welcome to call. It's a Google Voice number, so that means you have to state your name when you call. Otherwise, I don't know who you are, and to cut down on the riffraff, I'm not going to answer the phone. So there. So let's just recap a couple of these after-hour trades. We've got American Express trading down about 64 cents after hours. Intel trading, looks like it moved up after that conference call and then started to flatten out. Now trading down $1.14 from the close. Capital One Finance, a little bit more controlled. We had this scoop down into the call and then not much of a change after that. And that's pretty much a big hit. So there's Capital One trading down about $4.29. And AT&T also trading down about 60 cents, maybe 68 cents, or I'm sorry, 52 cents I should say, after hours. Let me find my ES chart. Let's see, nothing new there on K-Swiss. We'll close that down. And I'm trying to figure out what happened to, maybe this was it. I had the Wells Fargo open. And yeah, I think this is it because it says the time and sales on the side. So we'll just back this up. ES market, the new session is now open and currently trading down 75 cents on the day. Let me just adjust this a little bit. Don't like trading the futures without doing a little bit more analysis, but it does look like our stochastics are pointing upwards, and I'm going to leave that on the screen, the volume profile, although you can't see the numbers. Let me see if I can zoom out enough for you to see the numbers. That should do it. Okay. And that's about it. If you guys have any songs you'd like me to play, I'll be happy to throw a few of them in the queue and generate a little random radio based on that. In the meantime, I'm going to shut down the video and just reset it before we close things down. I got a couple more texts came in. Let me just see if there were questions or comments. I wrote back to a couple folks. All right, Tommy, you got it. And my phone is uncooperating here. So ES down 75. Let me see what gold's doing. Not that whatever it's doing now is going to mean a whole lot for tomorrow morning, but maybe I'll leave this on the screen for you guys. And gold trading down $4.30 right now. My Google Voice app is not cooperating, so we'll go into regular text. And looks like our viewer did get their question answered, so I'm glad to hear that. And okay, so we got a member checking in who is perhaps benefit from some kind of I believe a TTL arrangement. So what I will do is reach out to you separately. I don't know if you have an auto translator for what's being broadcast, but I will reach out to you and we'll see what we can do for you there. Definitely do have some visual aspects to the show that could help you out, and I'll talk to you about that somehow via text. after we shut this down. So thanks for tuning in, guys. This is the third show of the Briguy After Hours show, and hopefully be something you guys will find of interest in the future. I'm going to try to do at least 2 shows a week. Probably at this point, we're looking at Tuesdays and Thursdays at about 4:15 at when the pit closes, and let that run for a couple hours and see how it goes for a while. Next week, Wednesday, I believe Joel is going to be returning with the Option School, so we'll look forward to that, and maybe have some guests on that show. And of course, next week Monday is a holiday, so there won't be any markets trading on Monday. The futures has a little altered schedule. I think they close at about 11:30 Eastern Time Monday morning, and then reopen at 6 p.m. Eastern. So we can follow up with that tomorrow with John, and Athens perhaps will cover that on his show on Sunday night. So lots of things going on here, lots of shows going on. We thank you guys for your membership and checking us out. Be sure to check out the member forum. Learjet just posted something in there. I wasn't sure if that was a new posting or he was updating something, but be sure to check that out and post any comments in the room, watch some past videos, learn something, share your thoughts, comments, your hate mail, your love letters, whatever it is. We appreciate all the feedback. And thanks for tuning in tonight, guys. I'll get this reset, and we'll play some Who for Tommy. And if you guys have any other ideas, we'll play that too. So, good talking to you.